every single one of us here should be looking at investing as a way for us to build our wealth and also diversify our investment approach from some of the regular investment areas that we typically think about. The more common one for people in our community is real estate. So I'll be talking about the differences between looking at the stock market and some of these other investments like real estate. So I have a presentation that I've put together, which I'll share with you shortly. But as I walk through the presentation, the objective is, inform you based on my perspective on how to think about investing. And if you have any questions as I present the materials, please feel free to interrupt. I'm hoping that this session will be as interactive as possible. So feel free. You have any questions, you interrupt me, stop me if there's anything you want to clarify, or if there is any comments you want to make based on the information. So Baya, I think you need to give me the ability to share my screen. So glad that's disabled for a moment.
Let me transfer the host to you so that you can. All right, Azan, you are now the host.
Great. All right, so I hope you all can see my screen. So this is the title Baya and I came up with. We call this Stocks, Bonds, and Investment Strategy. It could be anything. Right? The whole goal is to just inform you all about how to think about investing in the stock market and the different strategies that you can use. From my perspective, as well as the best way to approach investing in the stock market. Because the same way you can make money in the stock market is the same way that you can lose all of your money, right? A lot of people, and it's the reason why some of us are very afraid to invest. But if you approach it with better information than the average person and more thought to the things you put your money in, you stand to make a lot of gains by investing in the stock market. And this next slide really highlights that point. So I thought this would be helpful, putting this together, because a lot of us don't think about putting money in the stock market this way. And I think this is the best approach. Baya, as I mentioned earlier, Baya and I came to the US in 2004. And Baya, I hope this is it's relevant to you as well. If we had put $10,000 in the stock market in some of these stocks in 2005, example, if you put Apple stock in 2005, your $10,000 will be $706,000 today.
Ah, damn.
If you put that 10,000 in Google, it will be almost 100,000. In Amazon, it will be 694. In Starbucks, that 10,000 will be 70,000. In Nike, you will have $200,000. So what that really is just telling us is there's very few other investments that this type of fund, and it's the reason why this market, in my opinion, is the best place for you to put your money if you're looking to grow.
Hey, Azan, can you mute Goke, please?
Okay, hold on one second.
Oh, I apologize, man.
No. Oh, you got it.
All right, guys. So essentially, the summary here is, if you're thinking about the stock market, there's no better place to put your money, is what this slide is saying. So for today's session, as I mentioned earlier, there are a couple of things that I think is going to be important for us to talk about. One is some key terms that you hear about. You've heard about capital markets or stock markets. Some people call it a stock market. We're going to talk about stock exchanges or securities exchanges. We're going to also talk about the type of securities or stocks that you can invest in and how to invest in the capital market. So these four things I'm going to address in various forms as we walk through the presentation. And as I said earlier, if you have any questions, please feel free to interrupt. If you have any comments, please feel free to interrupt. And like I said, I want to make this as interactive as possible. So what exactly is the capital market? Some people refer to it as a stock market. So it really, what it is, it's just a place where investors buy and sell stocks and bonds or any other type of security. Back in the days, the capital market used to be physical playground where people will literally go into that. I think back in the 70s and 80s when we used to have, before we had the internet, people will physically go into the New York Stock Exchange, take their money and sign a certificate that, oh, I want to buy this amount of stock. But today, what the stock market is virtual. It's like a virtual market that includes a bunch of different participants. And some of these participants in the stock market are the issuers of stocks and bonds. So you have companies who need to raise money to fund operations. They go into the stock market and issue stocks. An example is Zoom. So Zoom, we're on this Zoom platform now. Last year, Zoom used to be a private company that was funded by venture capital. Last year, they became public. So what they did was they went to the stock market or capital market and said, hey, we want to issue stock and investors will collect money from you in exchange for that stock. The US government is also an issuer in the capital market. The US government issues treasuries. So I don't know if you've been following the news, the US Treasury sold, I think, billions of dollars worth of treasury bills, treasury bonds in the last few months. And the reason for that is the US government needs money. We've been running a deficit. So the US government needs money to fund the deficit. State governments also issue municipal, you've probably heard of municipal bonds. State governments also go to the capital market and issue municipal bonds. Another participant in the stock market that's relevant for us to talk about are the stock exchanges. You've probably heard about NASDAQ, you heard about New York Stock Exchange. So what is these are virtual places that provide the infrastructure for you to buy and sell stocks and bonds. Other participants talking about, he opened his first retail investment account and started investing in stocks. There are also institutional investors. So institutional investors also buy these stocks and bonds that are issued by companies and governments. So you have examples of those are mutual funds, banks, hedge funds, and then you have the broker dealers. So the broker dealers are participants that actually facilitate buying and selling of stocks on certain exchanges. Example is the NASDAQ. So on the NASDAQ, you actually can directly buy NASDAQ. We'll address this later. You have to go through a broker dealer. You don't know that because when you place your order in, it's electronically. So the back end of the transaction that happens is facilitated by these investment banks. The other things that you need to understand as you think about the capital market is the indexes that are used to track how well the stock market is performing. You've heard of the Dow Jones, you've heard of the S&P 500. Another index that's worth mentioning is the Russell 3000. So what these are, they're essentially just indexes. So think about them as just numbers, values that help you understand how well the stock market is doing. If those numbers are going up, if the Dow Jones Industrial Average is going up, it means the stock market is doing well. If the S&P 500 is going up, the stock market is doing well. If the Russell 3000 is going up, it means the stock market is doing well. But what it also means, in addition to the stock market, is relatively the economy is also doing well because the stock market, to a large extent, tracks the performance of the future performance of the economy. So if investors expect that the economy will do well in the future, the stock market will go up. We probably all are familiar with the crash that happened in March. The main reason why it happened was people thought the economy was going into the toilet. But I think over time, over the next couple of weeks that followed that crash in March, people started realizing that, okay, maybe it's not as bad as we thought. And in addition to that, you also saw a significant amount of support provided by the Federal Reserve Bank, as well as Congress, spending money to not only provide income to people who've lost their jobs, but also the Fed providing liquidity to companies. So I just want to pause for a second if anybody has any questions.
Hey, Hassan, I do. So, are we also able to invest in all these, S&P 500, Russell, and so on and so forth? Because I think,
Yeah.
the last time you had me, buy into one of this.
Exactly. So we'll address buying. So those will address buying indices like this. So these are indices that track the overall market. And I should actually talk briefly about the differences between those three indices. So the Dow Jones is the oldest index that used to track the stock market. It includes 30, the Dow Jones only contains 30 companies. The index only tracks the performance of 30 companies. And those 30 companies were traditionally, back in the 70s and 80s, the best performing companies in the US stock market. So it's not necessarily the best representation of the stock market, but it's usually considered as, usually the one that, if you guys follow Donald Trump's tweets, it's the one that he follows the most because it's the most known index. The S&P 500 is actually a much better index that helps the stock market because the S&P 500 contains the 500 largest companies in the US stock market.
Oh.
So it's a much better index than the Dow. And then the Russell 3000 actually contains 3,000 of the largest US market indices. So the Russell 3000 is an even better index, but people rarely use that. The people only default to the S&P 500 because most of the smaller companies that are in the Russell 3000, people don't really pay attention to them. So S&P 500 is a better index. Now you can invest in these indexes, and we will talk about those later, as Bio was referring to.
Yeah, it's actually interesting, Hassan, because I never knew that the 500 or 3,000 actually meant something. I thought it was just so it's actually the number of companies that come together to make one index.
Exactly. So next we'll talk about these two exchanges.
Hassan,
go ahead.
Sorry. Yeah, sorry. Where does an institution like Zurich fall within this capital market that you just presented to us?
An institution like?
Is it?
You're breaking up, Sean.
Zurich.
Oh, Zurich. Is that Zurich? What's the name of the full name of the company?
Zurich, I think it's in Switzerland. I think they're like this. I want to believe they're part of this mutual. They're like mutual funds because I see you categorize these like you've got major indexes and capital market.
Yeah, so I see what. So I think you mean Zurich Investments. So it's a Zurich Investments.
Yes.
It falls under institutional investors. So I think they have it's a financial services company. So they have a bunch of products. They have mutual funds. They also have a wealth management arm, I think. So they will fall under the category of institutional investors. That's a good question.
Okay. Thanks.
Yeah. So I also want to briefly talk about the stock exchanges, right? And this may not necessarily be as relevant, but I think it's also important for you to actually know what these are. So the New York Stock Exchange is the oldest exchange in the United States. So it was founded back in 1792. That's more than 300 years ago. And so the stock market has actually been around for more than 300 years is what that should give you a sense of. It contains, so as a company, if you want to go to the market and list your shares, you can either list in the New York Stock Exchange or you can list in the NASDAQ. Both of them have different rules by which you should list. I think for the New York Stock Exchange, their fee for a company, if you own a company and you want to go public, you want to go IPO, you can go to the New York Stock Exchange and say, oh, I want to list in the New York Stock Exchange. But you have to pay, their fees are significantly higher than the NASDAQ. I think the fee is like $500,000. Also, the difference is there's a difference in the type of companies that list in either exchange. In the New York Stock Exchange, companies that usually list there are less volatile. I think there's about almost 3,000 companies listed in the New York Stock Exchange. Compared to the NASDAQ is relatively new. It's actually recognized as the first electronic exchange because when the New York Stock Exchange was founded, like I mentioned earlier, people will physically have to walk to the exchange to go place a transaction. And when phones came, people have to call in, oh, I want to buy this amount of stock, yada, yada, yada. With NASDAQ, it's all electronic. You go on your computer, you send your order in, and it gets fulfilled. Most tech companies prefer to list on the NASDAQ for a variety of reasons. One, their fees are lower, and it's just some type of network effect kind of thing. Because if you're a tech company, you want to be listed with other tech companies. So tech companies go to the NASDAQ. And the stocks there, because of that affiliation, are usually more volatile. Questions, comments? Oh, one other thing I want to talk about, the big difference here is the way the trades are executed. In the New York Stock Exchange is an auction. Like, so literally, if you place an order for a stock in the New York Stock Exchange, the order goes directly to the New York Stock Exchange, and it gets filled based on the an auction process. So whoever has the highest bid on a particular stocks gets buys the stock. So that's sort of like what drives the price up. So it's kind of like an auction. You keep buying, you keep buying. If there's more people that want to sell than buy, the stock likely goes down because people are selling. You're trying to reduce the price so you can get rid of it as quickly as possible. The NASDAQ is usually brokered by dealers. So the investment banks that I talked about earlier are the ones who place the order on your behalf. So that's one big difference between the two.
Hello. Hello.
Yeah, go ahead. You have a question?
Yeah, sorry. Yeah, so what I'm about asking the question is for the fact that, like if you are trading or you are a retail investor through maybe Robinhood, stuff like that. So if you are investing and you see lots of stocks, then you want to invest into that. So how shall I put this straight? So going through Robinhood, right? It means Robinhood basically under NASDAQ, not New York Stock Exchange, or they have access to the two stock exchange and
yeah. So the simple answer to your question is you just answered it yourself. Robinhood has access to all of these exchanges, both New York and NASDAQ. So if you place an order for stock that's in the New York Stock Exchange, an example is JP Morgan, it's traded on the New York Stock Exchange. What Robinhood does is immediately routes your order to the New York Stock Exchange. So your order immediately goes to the New York Stock Exchange and gets filled based on like the auction that's taking place. If it's a stock that's in the NASDAQ, example is Google. If you want to buy Google, the order gets routed through a broker dealer. The order goes to JP Morgan or one of those many broker dealers, and then they place the trade on your behalf based on the order book. I mean, the process is a little more complex than that, but that's essentially what happened.
All right. So if I may say, like apps like Robinhood, it's just like an intermediary, right?
Exactly.
Just like a passing as in a pipe from the investor and the stock exchange.
You just use the right word. They're literally just the pipe that passes from order to the exchanges.
All right. Thanks.
Great. So I also want to talk about the different types of securities that you can invest in, because the ones that we're all mostly familiar with are stocks. Before I go ahead, there was also one thing I now remember that I wanted to make. I know some of us are not in the US, and unfortunately the presentation is US focused. But the thing is, most of these concepts that we're going through are applicable in almost every stock market, except maybe the Nigerian stock market, because you all know how we are. So if you're in the UK, the same concepts apply. All of these different types of securities that we'll go through now are being traded on the UK stock exchange. So what are the different types of securities that you can invest in if you want to go invest in the capital market? So I'm going to focus on the capital market here and then talk briefly about the other three different types of securities. So money market, derivatives, and other indirect investments. So in the capital markets, the key types of securities you can buy treasury bonds. Like I mentioned, if the US government wants to issue bonds, it goes to the capital market and works with these investment banks, broker dealers, to sell its bonds. corporations also go to the stock market to issue bonds. So a company that issued bonds recently, I think was Amazon. They went to the stock market and said, hey, I want to borrow, I think it was about $10 billion that they raised. And they issue they'll collect, investors will buy those bonds, and Amazon will collect the money, and Amazon will be paying an interest on those bonds. State government also goes to the stock market.
Everybody will dance after many months of being out of church.
So who, I think someone that needs to be muted there. Okay, so going back, I was talking about state governments also go to the stock market. Companies also go to the stock market to either issue stocks in an IPO or in what's called a secondary offering. A company that you already know, let's say Google wants to raise more money in the stock market, they can issue more stocks. And there's another group of funds that are called ETFs that you can buy in the capital market, which we'll talk about later. Now, the reason why you buy most of these things, a lot of us, unfortunately, and I'm also guilty of this, fall into the habit of, oh, I see this stock or this particular security is trading at a low value. Let me put some money in so I can make a quick gain. Generally, the reason why you invest in the stock market is so you can make money in the long term. And I'm going to emphasize that point later on as well, because it's always easy to imagine the stock market as a place where you can make a quick gain. Usually you will end up losing your money more often than not. You may be lucky, make a quick gain. Like for instance, if you bought some stocks at last month, you may have doubled your money. But the truth is, that was more likely due to you being fortunate than you knowing the best investment strategies, because that usually doesn't happen often. So you invest in the long term, if in the stock market, and that should be the time, because the companies that are raising money to invest in projects for the long term. Now, the other securities that we'll talk about briefly, money market. So these are typically issued companies that need money for a very short period of time. Let's say it's 3 months, 12 months. Treasury bills are like, if the government needs money for 3 months, they'll pay back in 3 months. The US government goes to the money market and issues treasury bills. There are also what's called Eurodollar bonds. These are actually bonds by companies that are outside of the US who want bonds in US dollar. So example is, you've probably seen if you invest in Nigeria, some of our banks, they come to national market, Eurodollar bonds. An example is Access Bank. Access Bank actually goes to the market very often to issue US dominated dollars. Some companies for commercial paper, which are just short-term borrowing. And then there's also derivatives. You can also buy derivatives on the stock market. And derivatives are options. That's the most commonly known one. And some of us may have actually dabbled in options. I would definitely advise not to invest in options, although I do as well. But I know what I'm doing is not necessarily right. The reason why you typically will invest in options is to prepare, so manage risk. But a lot of us use it as a way to try to do very quick short-term gain. Unless you understand options, I will advise not to buy them. So if you can put the time into research, you can go. And then there are other indirect instruments like mutual funds or trusts and hedge funds, which I will advise we don't talk about that today, just because of not necessarily easily accessible to retail investors. Any questions on the side?
No
Yes,
questions.
I have a. Who
Somebody
said no questions?
Hello, please. Can you expatiate more
question,
on ETF?
No,
Okay.
one at a time. Bola Showa, okay, I see you on the sick bed. Hey, we need Kurosha. I apologize. Yeah, can you go over? Can you? I apologize. I joined the meeting a little late. I was on a different Zoom call. Can you go over? I've had the word bonds, and
Yeah.
I know I can Google it and read up on it. I mean, since I have the opportunity of an expert here, can you just tell me what bonds are so I can know it once and for all?
Yeah, absolutely. So great question. So bonds are securities that are issued by companies who need money to fund need to fund an operation. However, there are differences between bonds and stocks. And I think what you're trying to understand really is how bonds are different from stocks.
Absolutely, absolutely. Yep.
The main difference between bonds and stocks is bond is like a loan. Essentially, that's what it is. It's a loan that a bank goes to the market and collects, and they promise to pay an interest on that loan to you. Unlike a stock where you don't get the promise of an interest payment, with a bond you get the promise of an interest payment.
Okay.
With the bond, you also don't have ownership of the company. With the stock actually confers on you an ownership stake in the company. So if you buy stock of McDonald's, you actually own part of McDonald's. With the bond, you don't own part of McDonald's.
Got you.
The other difference is with a bond, you also have it's also less volatile. The company has promised that I'm going to pay you 5% interest every year. Because they're usually less risky than stocks. They have a higher, higher placement in the capital structure. The way to think about that is bonds they have less, they have
Risk.
a higher, I'm trying to find the right word here. They are higher in the capital structure than an equity holder. So if a company is running out of cash, they have to pay the bond first before the equity guy gets it. So that's one of the major advantages of bonds. But the problem is they usually have lower returns than stocks.
Okay. Can a retail investor does retail investor have access to bonds? I know it's listed under the capital market.
Yeah, you do have access to bonds, but however, I will advise against buying bonds the same way you buy stocks. And the reason is bonds are less liquid than stocks. So what that means is if you buy a bond, most likely you're dealing with one-on-one and you're dealing with somebody else directly.
Brokers.
So unless there's somebody who's really, if you buy a bond today, I've run into that issue before when I first started trading too. I bought Microsoft bonds and I realized that, oh snap, 3 months later I wanted to sell it. But I couldn't sell it for like 5 days because there was nobody else who wanted to buy it. So even if I placed my order on the exchange, the order didn't get filled until 5 days later.
Yeah, until there's a buy order for it.
Exactly, and there's a buy order for it. So that's with stocks, you have significantly more liquidity because there's more.
Got you. Makes sense now.
What you can do if you want to buy bonds is I advise to buy ETF bonds. ETF bonds have more liquidity. And somebody asked a question like, what's an ETF? We'll talk about that later. And when we talk about ETFs later, I'll explain exactly why we have more liquidity. So there are different types of ETFs. There are bond ETFs, there are stock ETFs, there are different types of stock ETFs.
Then, sorry, hello?
Yeah, go ahead.
Yeah. So there is this thing I want to, when we talk about bonds and stocks, now I understand that the bonds are like, you are giving a loan to a company.
Yes.
So you don't have anything, you don't have any stake in the company other than just the money you are giving to them, and they're paying you a particular amount of interest on the money you are giving to them. But the stock is being traded, it fluctuates, it might give you 5% returns, it might give you 200%, it doesn't matter. But something I'm trying to learn about, but this one is called about investing directly, real estate. I might not have a lot of money to start that, but there's kind of thing I'm reading online, and I'm trying to educate myself, whereby maybe just like crowdfunding, just like crowdfunding stuff. whereby you have there's a project, everybody buys into the project, you put money into the project,
Yeah.
and it's kind of equity. I mean, I think what I'm reading, I mean, kind of equity. Some you have equity, some you don't.
Yeah.
Is the same thing as, or how does it relate to a bond, or is it a different thing entirely? Does it have?
Yeah, I think I understand. Let me address the question. I think I get what you're, and it's a great question to ask because it took me a while to understand as well. Crowdfunding is completely different concept than capital market. Even though for any company that goes to crowdfunding, the goal is the same. You want to raise money. From the retail investor standpoint, what you get is different. So crowdfunding is essentially a company goes and says, "Oh, I want to raise money because I want to build this product." And there are two things that the company can do. The company can decide that, "Oh, in exchange for your money, I'll give you shares in my company." So it's the same way you invest in a venture company. So that's called like the venture part of crowdfunding. But that typically is not what happens with crowdfunding. Usually what companies do is they say, "Oh, if you give us money, the first product we build, we'll ship it to you for free." I mean, it's not really free because you gave them money to build product. So that's the main difference between crowdfunding and what you get in the capital market. You don't have the promise of an interest payment and your capital back with crowdfunding. And at the same time, usually you don't have ownership stake in the company that you're crowdfunding for. So crowdfunding from an investor standpoint is not really a place you go for returns. You go for it to support maybe particular products or ventures that you care about.
Thanks, sir.
Yeah. Okay, so somebody asked what's an ETF earlier. And the reason why of all of the different securities here, why I think ETFs and mutual funds is my general advice, and this is what I do. These are literally the only three types of securities that you should really care about. Every other security, they're either illiquid, too risky, too complex, because one of the advice I can give is if you don't understand something, typically stay away from it. You know, because I follow that. I try to follow that advice. Like there's a lot of securities that I don't understand myself. Because some of you have probably heard about mortgage-backed securities, ETOs. All of those things are so complex sometimes that if you don't understand it, most of the time you may lose money if you invest in it. So the three securities that you should mostly focus on when you want to invest are either buying stocks, buying ETFs, or buying mutual funds. So what are the differences between all three? I think I talked about them one or the other. So stocks are essentially security that grants you ownership in a company and represents claims on assets and liabilities of the company. An ETF is like a basket of stocks or bonds that give you exposure to particular segments in the market. So somebody asked earlier, what's an ETF? An ETF could include just stocks and includes a particular type of stocks. So an example is if you want exposure, one of the key market trends that people heard about cloud. So the cloud technology is a new trend that is driving the software industry, where companies are taking their application from on-premise servers to like servers hosted by big cloud providers like Amazon, Microsoft, IBM, Dell, etc. So if you want exposure to, say, cloud computing because you think it's a trend that's going to get even more massive, you can buy a basket of stocks, basket of cloud stocks in an ETF, in a cloud ETF. You can also buy bonds. If you're like someone who's worried about the economy going into the economy doing poorly, you can say, you know what, I want to invest in bonds because bonds are less risky than stocks. So you can buy an ETF that only contains bonds of good companies or AAA rated companies is the term we use for good companies. Now, mutual funds, on the other hand, are slightly different from ETFs. Mutual funds are like, it's like think about a pool of money. And if you have a 401k, you probably only are able to invest in mutual funds. So it's a pool of money that's managed by a professional, someone who considers themselves a professional, and they invest. They act select the stocks and bonds that go into the mutual fund. Unlike an ETF that's like automatic, the ETF just picks a theme and picks all of the stocks that correlate to that theme. And it's like passively managed. Nobody's buying or selling anything into the ETF. The mutual fund, the so-called professional, is buying and selling stocks that goes into the fund. One of the key differences between stocks, ETFs, and mutual funds is the level of risk. With stocks, if you buy one particular stock, your level of risk is very high because not only are you exposed to, like, oh, if the economy is not doing well, this stock is not doing well. You have some stocks that are just like bad companies, and you may not have that information until later after you've invested, and then your money goes to zero. So you run the risk of concentrated loss of capital if you invest in stocks. ETFs and mutual funds give you diversified exposure because they don't just contain one security. They contain a basket of securities. So even if one doesn't do well, another one may do really well. Another difference is the time of trading. So stocks you can buy throughout the trading day. The markets open at 9:30 a.m. and close at 4 p.m. You can buy stocks at any time during those trading hours. You can even buy stocks at extended hours of trading. So extended hours means for some investors, the markets open actually at 5 a.m. in the morning. They call that extended hours. But I would typically advise don't trade in extended hours because there's less liquidity in extended hours. There's one ETF also traded throughout the day in extended hours. You can only buy once a day after the market closes. So you can place the order in, but the order won't be fulfilled until the market closes at the end of the day. In terms of fees, usually you don't pay any fees when you buy stocks. With ETFs, there's usually very little fee, but you also pay what's called an expense ratio. So meaning if you own a certain amount of an ETF, they charge you like 0.05% or 0.2% annually for owning that ETF. Mutual funds, usually no commission fees, but they also charge an expense ratio. The expense ratio for mutual funds is higher than ETFs. And we'll talk about some of the differences later, but for now, just understand that that's a concept that you need to understand when you're trying to decide between ETFs and mutual funds.
Hey, Azan, quick question for you. Somebody wrote in the chat group that would you advise buying HFTs or does it mean ETF? Mark, do you mean ETFs?
HFTs.
Oh,
HFTs. So let me. I don't think I'm familiar with what HFTs are.
High frequency trading.
But those are not necessarily securities. I'll explain what high frequency trading is. So there are some companies, they are categorized as hedge funds because you can invest in a hedge fund, but usually you don't have access. Retail investors don't have access to it unless you have a lot of money. So there's like companies who collect money from investors. If you're like a millionaire, you can typically invest in a hedge fund because they want to collect large sums of money from people and invest in. So a group of hedge funds are called high frequency traders. And what they do is they build this really sophisticated technology system that are able to route trade to the stock market, to the stock exchanges much faster than anybody else. So I give you a classic example. So you guys remember March, the market crash that happened in March?
The millisecond crash, yeah?
Yes, the crash that happened in March. What high frequency traders do is they build all these sophisticated systems and have all these sophisticated algorithms that try to assess how the market is going to trade. So what they do is they front run the market and they don't necessarily front run the market because they have more information than you. They do sometimes, but usually it's because they're able to analyze all sorts of data and see how the market is going to react and place trades in advance of the market. So I don't know if any of you remember here, this company there's this Chinese company called Luckin Coffee.
Yeah.
So if you,
I heard about that.
so
They
Luckin
cook the
Coffee,
goats.
give the things, the rest of you some background. So Luckin Coffee is a Chinese coffee company, like the Starbucks of China. The stock has been doing really well. But people found out that there were news that came out that the company had actually been forging their numbers.
Yeah.
So they were forging their revenue and their sales numbers. And once that information came to the market, everybody who owns the stock will want to sell. If you're a high frequency trading firm, you likely have access to that news much faster than everybody else. And not only that, because you build these sophisticated systems, many of them actually build their servers close to the stock exchanges. So when they place an order in, the order get routed to the exchange much faster than you, who's based here in Maryland. So some of them build servers literally right next door to the New York Stock Exchange. So when they place an order in, the order gets to the New York Stock Exchange faster. So what they do is they're able to sell securities much faster than somebody who's placing an order from Maryland or from Houston. So because their trades get placed faster, they're able to sell at a much better price than everybody else. So that's what like high frequency trading is. They literally buy before everybody else is buying and then get in at the lower price. So does that explain really what high frequency trading is? I just want to make sure I ask the question. Who asked that question? I don't know who asked the question about high frequency trading.
Yes, it does explain HFTs.
Okay, great. So if you want exposure to high frequency trading, you have to find a hedge fund that does high frequency trading and give them some money.
Yeah, I think they've opened up some HFT algorithm softwares to the public.
Oh, guys, so you can actually use the algorithm and build your own system to route the stocks. Route your orders as well.
Yeah, but I understand where the disadvantage would be when you are not close to the stock exchange. So
yes.
they would definitely place orders faster than you.
Yes, yeah. And that's exactly usually, they try to get an advantage over other investors in the market by using, by trading off, by using the access that they have. So the reason why they call them high frequency, they trade really often and faster than everybody else.
Hey, Azan, there's a question here. I'm sorry. Explain hedge funds, please.
Okay, so before I explain hedge funds, I want to help you think about mutual funds. Okay. So we talked about mutual funds. A managed pool of money. You have a portfolio manager who picks the stocks and bonds that goes into the mutual fund. And you can buy, and the mutual fund is packaged as a security, so you can actually buy it. A hedge fund is very similar to the mutual fund. It's a managed pool of money as well. So think about if Bayo and I today, we can decide, we know a lot about investing, we're very sophisticated, we want to start a hedge fund, or we're going to collect money from all of you. So that investment group that you guys started, that you guys are talking about starting, you can call it a hedge fund. The only difference between that and a mutual fund is it's going to be closed, meaning that nobody else, once you raise money from people, you've collected money from people, nobody can buy and sell. The only person who can buy and sell into the hedge fund is the portfolio manager of that hedge fund. The reason why they're very notorious is the fact that they have very aggressive investing strategies. And when I mean aggressive, it means not only are they taking like concentrated risks sometimes, they are also
why for you and Kevin?
They're able to access other investors are not able to. So sometimes
my credit's good, but I ain't got no job.
Azan, mute Ayodeji's phone, please.
Okay. All right. So hedge funds are able to act. They have more sophisticated strategies. Because they're able to invest in research, they have more access to information than the average person. So they also adopt strategies that you and I may not necessarily be able to. So example is they buy derivatives or have different hedging strategies to protect the value of the portfolio. So essentially what they're just sophisticated investment vehicles, which you only have access to if you have a lot of money.
Okay.
Great. So how do I start investing? I don't think now that I wasn't sure about everybody's relative sophistication with investing, but it looks like this is a group that's like very familiar with the stock market. So I wouldn't really go over this slide. If you want to start investing, there are a bunch of different brokerages that you can.
As long we have novice here, I beg.
Okay. All right. We'll talk briefly about this. So if you're wondering how you can start investing, the quickest way is to open an online brokerage account. And I included some of the most well-known brokerage companies here. Robinhood is a very popular one today among millennials and the younger generation. And the reason for that is they've built a very simple, easy to use platform. And they were actually the first company that started offering free trades. It's only recently that everybody else has realized that they may lose all of their money to Robinhood if they don't start offering free commission-free trades. So, but the other companies you can use have some advantages over Robinhood. And some of the advantages are they have better research tools than Robinhood. So if you want to learn more about a stock you're investing in, if you use Fidelity, for instance, or E-Trade, they have way more research about that stock than Robinhood will. So just go online to any of these companies' websites, open an account, fund the account from your checking, and you can start buying stocks or whatever ETFs that you're interested in. Now, what if you still don't feel comfortable about picking the stocks or ETFs that you want to invest in? You can use a wealth advisory firm. So companies like Fidelity, Merrill Lynch, JP Morgan, there are thousands of wealth advisory firms out there. And some of you may know one that's like local, but some of these are like more national. Some of the characteristics of these wealth management firms are, some of them actually require you to have a lot of money before you can invest with them, before they can invest your money for you. So like, for instance, I know at JP Morgan, the minimum is usually like $1 million. Some of them are lower. Some of them could start as low as $100,000, depending on how small they are. But they usually have high fees, and they offer you like personal relationship. It means you can always pick up the phone and talk to your personal financial advisor. Now, there's this relatively newer group of investors called robo-advisors. These are companies that actually help you automatically invest your money based on your risk appetite. So if you're someone who doesn't feel comfortable opening your own brokerage account, you can say, you know what, I want all these robo-advisory firms. So what you do is you just go to the website and they ask you what your risk appetite is, give them money, and then the computer algorithm that they built automatically invests the money for you based on your risk appetite. So they usually have minimum investment requirements or none at all. They charge you low fees. But usually there's also no personal relationship, meaning there's nobody who's really advising you about where the stock is going. They have customer support for the platform, but for the investment advisory itself, there's very limited interaction with a person.
Hey, Azan, quick question for you.
Yeah.
I think at from your last slide, you said something about those who can buy into hedge funds market.
Yeah.
So, somebody is asking, who are those people that you said can only buy into hedge funds?
So they're usually wealthy people. If you're like someone with $5-10 million net worth, you may be able to put money in a hedge fund, because they ask you, the hedge fund, they may say minimum investment is $5 million. And they say you have to lock that money in for 2 years or for 3 years. So if you're somebody who may potentially need that money, you may feel uncomfortable investing in a hedge fund.
Got it. So also, somebody is asking, so which of these brokerage accounts would you recommend?
So I personally use Fidelity, and the reason why I use Fidelity is because all of my 401ks are Fidelity. My 529 accounts are also with Fidelity. And so it's just a platform that gives me ability to manage all of the different retirement accounts that I have and investment accounts that I have. I also use Robinhood, but I have a smaller percentage of my assets with Robinhood. Most of my assets is with Fidelity. But the truth is, if you're someone who cares about research, you want to read about, this talk, you want to find data or find other people's view about these stocks, Robinhood may not be the best place. Robinhood is the easiest to use. You pick up your phone. All of them have mobile apps that you can transact with, but Robinhood is a more simple, easier to use platform than every of the other ones.
So you recommend Fidelity over Robinhood, so to say?
So to say, yes, if you want to do research, or if you want to just make quick trades, Robinhood is okay.
Hey, Hassan, can you talk about trading options, please?
I don't want to talk about it. I don't think we should talk about it.
I have one question, if you don't mind.
So go ahead, Viz.
The previous screen, the robo, if you want to go back a little bit.
Yeah.
Yeah, the robo advisor. So let's just assume I pick one, Betterment, and they automatically do my trading for me. If I'm trying to sell, I'm trying to get out.
Yeah.
Will it be the same way? I can just go in, even though they're automatically investing for me. So I've made profit and I want to sell. Is it difficult just to go in and place my sell trade?
They make it very easy, and that's one of the reasons why they may actually be a good option. You can go into their website, just say, "Oh, I'm ready to sell everything," and then they'll sell it and get you your money back.
Got you. Thank you, sir. Appreciate it.
So if
are you saying that Fidelity is much flexible in terms of selling your stock?
Not necessarily. They're both the same thing when it comes to buying and selling. You place your order and they both route it the same way to the markets. So it's not, to the exchanges. So one of them is not going to help you sell better or buy better. It's just ease of use of the platform itself, the app. Robinhood is much easier to use than Fidelity.
So these two companies that you just explained, are they just specifically into helping people to buy stocks or shares in another company, or is there any other thing they're known for?
Yeah, so that's exactly what they are. They help you buy and sell shares in other companies, but they do it on your behalf as your what they call fiduciary. So they're representing you, and they've promised you in exchange for the fees that you pay them that we will help you get good returns in the market.
Oh.
Hello?
Yeah.
The difference has the other screen where you have the E-Trade Fidelity. The previous. Okay, yeah, this screen. If you talk about E-Trade Fidelity and American Trade, are they commission-free applications?
Yeah, so most of them actually have become, they don't charge money for trading stocks anymore, as of a couple of months ago.
Wow, interesting.
Yeah, it's interesting because they were all going to lose share to Robinhood. And once the first brokerage, the one I don't have is Charles Schwab. Charles Schwab was the first so-called traditional investor that decided we're not going to charge any commission fees anymore. And then all of a sudden, every one of them just followed. E-Trade, Fidelity, Interactive, Merrill, Ameritrade. Nobody charged for trading stocks anymore.
So Robinhood would be the challenger trade broker then?
Yeah, it's the challenger. It's like the incumbent. Not the incumbent. It's like the what they call it. The challenger is the right word.
Azan, so what trading options?
Okay. And derivatives.
I don't want to talk about it. Sorry, guys. And the reason so I'm going to talk about it. So so-called derivative instrument that derive buy a particular stock at a strike price in the future. So example is let me find your stock. Example is Zoom, where you're on the Zoom platform. Zoom closed on Friday at about $200. You can buy a call option for Zoom that gives you the right to buy call at 200 in 6 months' time. You pay the issuer of the option a fee. And in 6 months' time, if Zoom's price is 300, if you feel a certain way, if you feel the stock price is going to significantly go up and you want to magnify your gains, you invest in call options. If you think the price is going to significantly go down and you want to magnify your gains, if the price go down, you buy what they call put options.
Okay.
So that's all I'm going to say. I would generally advise to stay away from options. Options, if you want to invest in options, if you have the mindset that it's not going to be any different than me going to Vegas, then that's fantastic.
So what if I have let's say I'm a farmer, which I'm not, obviously. I'm just trying to see if there might be people who would benefit from that. So if I'm a farmer and I want to sell my products on a future trade, and I'm trying to leverage my loss if there are any. For example, most what's the word now? Those guys are the air traffic guys, the airplane companies. They're making losses now. What if I've locked that down at a good price at this time and I call in my options to trade? I mean, wouldn't that be something someone who is a farmer and wants to lock down the price of their produce in the future?
So that's exactly, if you look at this slide, when I wrote derivatives here, risk protection, what you just described is the reason why options, derivatives such as options and futures contracts were designed, is to protect risk. You want to lock in a price, you're protected, and because the reason why you want to lock in a price is to protect yourself from downside risk. That's why derivatives were created for people who want to buy and trade them now for speculative reasons. And you can potentially lose a significant amount of money in a short period of time if you trade these derivatives. And that's why unless you really understand and you have very strong convictions in either direction, I will recommend staying away from these derivative products.
So Azan, so somebody asked, I'm not sure if I understand the question correctly. You said, isn't options betting against?
You can do both. You can either bet against a position or bet that the position will go up. So if you are looking at the stock market today and you say, you know what, I think a particular stock is going to go significantly up, right? You can buy call options. And what you do is you magnify your gains in that particular stock. If you think the stock is going to go down, you can buy put options or even sell call options. So like all of us, I don't want to go into the conversation. You can actually buy or sell options. You can buy a call option if you think the price is going to go up, or you can actually sell put options if you also think the price is going to go up. Conversely, if you think the price is going to go down, you either buy put options or you sell call options. Either way, you make significantly more money than if you bought the stock itself. But that's where I think we need to move on from options, guys. One of the reasons why I wanted to avoid that conversation.
The reason I'm asking is it might just be a solution for someone's problem. I'm also thinking, I mean, don't I have the right to exercise my option or not exercise my option? And then all I lose is my fee.
Yes, you do. But before you get that right, you may have lost all your money. No. So that you're right, an option confers you the right but not obligation, right? Yes. So if you don't like the way the price or you don't think you want to exercise it, then you can call it off. Okay. Just let it expire.
Hello, Azan.
Yeah.
Hello? Yeah, someone is asking a question about is it only people in United States that can? I mean, people outside of United States use these applications like Fidelity, Behood, and stuff like that?
The problem is because of the US government actually regulates the stock market here, and because of money laundering and terrorism financing reasons, they don't. If you don't have a US address, you usually cannot trade. You usually cannot use any of these US-based stock brokerages. So unless they can verify your address in the US, you are not allowed to trade on any of these brokerages. However, if you're from the UK, there may be brokers that actually give you access to US stock exchanges. I know that in the US, this particular company, Interactive Brokers, one of the companies on this slide, they are probably one of the more comprehensive platforms in terms of their offerings. So Interactive Brokers actually allows you to buy stocks in exchanges outside the US. So if you're someone who wants to buy stocks in like the Hong Kong Stock Exchange, Interactive Brokers offers a more comprehensive access to exchanges outside the US. And I'm guessing if you're outside of the US, it's like if you're in another country, there may be brokerages like Interactive Brokers that give you access to the US Stock Exchange, but they're usually not a lot of them. So you have to really do a lot of research to find them.
Thanks, Azan. Let's move on. We are now an hour into
I have to run very shortly, but I want to talk briefly about two categories of stocks. If you're interested in stocks, there are two categories of stocks that you typically should think to start with. There's what we call value stocks, which are the traditional companies that we've known for a long time. They offer you stable growth, usually pay a dividend. They're less risky and volatile. The drawback is they usually underperform the stock market index. And then there's the growth stocks, which we all love and care about. Zoom is an example. If you've been following Zoom, PayPal, Facebook, Tesla, Nike can sort of straddle value and growth, but I'll consider them growth. And these stocks offer you high growth of your capital. They don't pay a dividend, which can be a disadvantage, but your capital is significantly appreciating. They're more risky and volatile, so you see the price go up and just drop. Zoom is $200 today. It can become $150 tomorrow. They outperform the stock market usually in the medium to long run. In the short term, it may not, but in the medium to long term, they definitely always outperform the stock market. So key questions to ask when you're evaluating a stock. I think all of us here, we've been asking the right questions, right? And I wanted to just lay out, as you think about what stocks to pick, these are some of the things you want to ask yourself and make sure you answer adequately and get comfortable with before you pick a stock. So do they have great products that are better than their competitors? Is there a large addressable market for them? And is there room for growth in that market? Good management team. Do they have strong financial performance? And there are potential risks that may impact the performance. A good example of that question, I wanted to make sure I highlight this, is you want to make sure you understand all the risk factors that may impact the company's performance. Example is Uber. As a lot of us use Uber every day, and we all think that Uber is a great company, it's going to continue to grow because there's such a large market for them. However, Uber is one of the riskiest companies to invest in because of some of the issues that they potentially may face. They have, in every market that they operate, they have regulatory constraints around what they can do. They're fighting the battle now with California about how they classify their drivers as part-time or full-time workers. What that means is if they're currently classifying drivers as part-time workers, if they have to reclassify them as full-time, their cost base significantly goes up. And all of a sudden, the stock market the company may not be as valuable as it is today anymore.
So you're saying their reputational profile affects their prices?
Yeah, exactly. A reputational profile of a company may affect its price. If people don't think Uber is a good company that's like socially responsible is one, or they think they're flouting government laws and they should be held accountable, it may also affect the price. So I probably just go ahead.
Sorry, there is something I've been for like today is 6. I mean, for like 4 days now, I've been reading about it, and I'm looking into. Sorry, it might be a little bit diversion, but I think for those that might be interested, there's a company which I was reading about. You know, we knew Tesla, right?
Mm-hmm.
So I was reading about Nikola. It was a company, but this one is going to be focused on that is the stock name is NKLA. So I don't know. I'm just thinking because I keep thinking about the future because the way Tesla just blew up, you know, it's I can't buy Tesla now except I want to buy except I want to kill myself. You know. So but I'm just reading about those things. Is it advisable?
Where did you find Nikola? How did you find Nikola?
Bro, I'm reading every day about these guys.
So it looks like Nikola, I just did a quick research. I'm doing some research on Yahoo Finance. So Yahoo Finance is a tool that I use to quick research on companies. If I want to do more detailed research, I would typically go into Fidelity. So it looks like Nikola is a company that's trying to take on Tesla.
Yeah.
The truth is, you don't know enough about them to invest in them at this time.
Okay.
You invest in it for highly speculative. You can say, oh, maybe I'll just pick $500 and put in this code in case it blows up. But the fact is, you don't know much about the company. You don't even know if they're going to be able to produce an electric car, right, or an electric truck. Looks like they're trying to be in the truck segment. So typically, you want to make sure that you're informed before you invest in a stock, and you want to make sure that you're not. Otherwise, what's the difference?
This Nikola is as in C or as in K?
It's N as in Nikola.
Okay.
Yeah. So we don't know. You don't know their product.
Okay.
They just say they're going to make a great product, right? So I'm also going to talk about briefly how to pick. We've talked about stocks. I'm going to talk briefly about how to pick ETFs and mutual funds. There is 3 things you want to look at in ETFs. I think we talked about in ETFs, a basket of stocks or bonds. So you want to look under the hood, see what's in it. Second one is you want to understand the expense ratio. And then third one, which is typically more complex, is like the tracking difference, because an ETF is supposed to track an index, and sometimes it doesn't do it 100%. So there may be tracking error with an ETF, and you want to make sure you know what that is, because if an ETF has a much lower has a high tracking error relative to its reference index, it's not a good ETF.
Okay.
So an example is this SPY ETF. So SPY ETF is the ETF that's designed to track the S&P 500. And it is probably the most popular ETF in the stock market, and it's doing really well. So when you go, this is actually screenshots from my Fidelity. Price of the
making money, bro.
Huh?
So you're making money, bro.
Nah, this is just the price of the SPY as of last close. So if I'm just talking about doing quick research on SPY, this is the price. I want to see what stocks are in it. So you see all the stocks: Microsoft, Apple, Amazon. All right, I like this ETF. I look at the expense ratio is 0.09%. That's relatively low. And I look at the tracking error, 0.14. That's also relatively low. If you start seeing tracking errors of 0.5 all the way to 1, that's a terrible ETF.
What is this net expense ratio?
Net expense ratio. So that's how much they charge you. If you have $10,000, they charge you 0.09%.
It's really nice.
I want to make you the host because I want to call in. And the reason why I want to call in is I have to make a run now, but I want to make sure that I'm answering everybody's questions. Is that okay?
Yeah.
Okay. Baya, please take over the host. So the next slide here is like why you should not invest in the stock market. And Baya can send you these slides. Baya has actually why you should not invest in the stock market. So guys, can you hold on while I log in for my phone?
Yes, sir.
Yeah, can you hold on 1 second?
Bọ́lá ṣe wà ókè ṣá.
Bàbá mi, ẹ pẹ̀lẹ́ sà.
Bọ́lá ti ń ka kúbóyè máa ra stọ́ọ̀kì Nikola yẹn.
Bàbá mi kan tí mo ti òfin If you research Nicola, make I know, man.
Mo wo site mo wo Nicola báyìí wájú mi báyìí.
Wàláì mo get ẹ̀ bó ṣe ń ṣojú yẹn mo rí bó ti ń tapá mi fún
Mo wo Nicola wájú mi báyìí.
Ó fi mi mọ̀ bó ti di R&D báyìí o.
But I like truck wọ̀nyí. Truck wọ̀nyí make sense, man. But the battery life for the cars are like 300 miles, which is like 400 or 500 kilometers, right?
Tó bá o lè gbé lọ látẹ̀kọ́ lọ sí Igbó Adẹ́rẹ̀.
No, we'll never be charged, look. No, we'll never be charged. Tó bá lọ lo inverter ó lè lo 1 year kó tó charge full.
Ẹ̀mí inverter yẹn máa lánàá gan.
Inverter yẹn kò máa lánàá.
Bọ́lá ṣe wà okay, sir?
Bro, I'm okay.
Eléyìí tó sùn sórí bẹ́ẹ̀dì.
If you're listening for Nigeria, I'm build charge stations on everywhere.
Mo lọ play ball kan lé ní, man. Ball yẹn
What is lockdown?
I'm all you get my lawn tennis, man. And lawn tennis with the play, man.
Lawn tennis.
That's social distancing game, yeah.
I'm on my boys, man. We play lawn tennis, man.
Lawn tennis that, but I want to be really good at it. I want to be really good at table tennis, though. That full lawn tennis. I mean,
No, Baba. Lawn tennis, man. Like I'm a play. We got a game every Friday, Saturday, Sunday. We play at 6 p.m., bro, to 11, man. No anybody fun, man.
Wow, that's
lawn
nice.
Tennis is good. Lawn tennis is good. But yeah, not good. It's good, yeah.
But if you play it, you worship you will learn to respect Serena Williams. Man. It's not easy, bro.
It's quite hard, I know. It's quite hard because even service last go before you know how to serve. Fam.
Right.
Ìgbà tí mo ti dán wò lẹ́ẹ̀mejì tán ti embarrass mi ni mo yá jókòó lórí.
Bàbá ìgbà tó máa ṣàrògbó fún ẹ wáyé ò ní bọ̀ ẹ̀ níta.
Wà á mú mate ẹni náà.
On the lighter mood, there's a guy that came, man. But why a terrible decade? One of the guys said, "When you like the Ludo, I'll play Ludo on the side, man. She.
Madi, what do you mean?
Mo ṣe ń wá ní òun ní mo ṣe ń pè níyì ń sọ̀rọ̀ mo ṣe ń wá kiri.
Ẹjọ́ níyì dà.
Kò yé mi náà bí tó ókè òun ní òwá wì. Mo ṣe ń wò pé ó rí bọ́bọ́ yìí.
So níyì ni òwá wì níyì lórí ẹ̀ tóbi bẹ́ẹ̀ yẹn mo gbé.
Ẹ ń ṣe name change ní kí ló ń ṣe yín?
Kí ló dé níyì kí ló dé ẹ̀ tóbi báyìí mẹ́n?
Orí mi lára tó tiẹ̀ ní kí ló wọ́ ẹ̀ orí lára.
Mi ìmọ̀ pé ní ìnìyẹn mo ṣáà wò ojú yẹn pé ojú yìí ti dúdú jù mo ò rójú ẹni yẹn dáadáa.
Ó mọ̀ pàápàá mi ìṣòro ibi light wà. Mo ṣáà fún mi gbóhùn ẹ̀bùn I don't know who be this guy. Wọ́n lè ní tó ti gbowó yóò yí.
Nicola yìí ó máa make sense there o. We have to watch out for it, man.
Who buy hairline? Benga showed our hairline, man. So their hairline this past week. They went crazy yesterday. Airlines went crazy, like I don't know, last 2 days. American Airline, United, man, those guys went crazy, man.
Yeah.
I don't know.
I think Benga signed up, right?
They went crazy, man, in the last couple of days.
They're coming back to operation, so they can bet that they would make a profit, so they will drive the price of stock.
Yeah, I believe so. I mean, I don't know if it's going to be permanent, but I guess it's because the economy is reopening back up. So, you said, the enthusiasm you just drove the market and everything shut up. I mean, as of last week, America was trading about 950. Yesterday was 22. It was trading at 22. It's incredible. I'm telling you, man.
22 per top. That's like 18. Wow.
Yeah. man. I missed out, man. I sold early.
Kilo.
Mo ní ṣe orí wọ́n sọ bí professional ó dẹ̀ ń pé iṣẹ́ tó wá ṣe nìyẹn wọn àti òbí.
Mo wá láà ní orí tí mo Hassan ni olóòlù experience. Àwọn kan ṣe side job ni. I won't be like that. Now Hassan get the whole thing. I won't be like Hassan.
Ọ̀nàkọ́ wọ́jà.
Ọ̀nàkọ́ wọ́jà o.
Eléyìí tó òfin àti báyọ̀ ló wá fi stock market ṣiṣẹ́ ṣe ń sìn ọ́ ẹ̀.
Èmi gan máa develop interest in stock market.
Mura Boeing. Mo wo Boeing lánàá mo ní oh my goodness.
Ṣé kìí ṣe ibi tó lọ fowó palliative sí nìyẹn?
Ibẹ̀ ni mo ti sọ.
I am struggling to make you the host, man. I don't even know how to do that.
No, I got it now. I got it.
Oh, you got it? Okay,
yeah.
Great. Okay, so give me 1 second while I share my screen.
No, I shared it already, Hassan.
Oh, you're sharing? Okay, great. Can you move to the next slide, please?
Okay. Are you seeing what I'm sharing now?
Yeah, I'm seeing what you're sharing.
Okay, next slide. All right.
What we can see is final version of presentation.
Yeah, okay, great. Yeah, can you make that full screen, please?
Mr. Hassan, I hope you're not driving.
No, I'm not driving. My wife is driving.
Okay.
Yeah, we had an appointment for 3 o'clock, so we're just trying to head over. Sorry. So, Bayo, so this next slide that I want to show you is, we've talked about stocks, we've talked about ETFs, we talked about mutual funds. And my advice, generally, if you're someone who's looking at the stock market as a way for you to build long wealth, I'll advise you generally stay away from buying individual stocks. And
individual stocks as in what?
As in like just buying an Amazon or buying Google stock or buying, you talk about Nico, somebody mentioned Nikola. I'd generally advise from buying individual stock. And the reason for that is literally this chart that I just showed. And then these are 3 examples of companies that a couple of years ago, you may have considered them as great investments for your money. It's like one of them is Macy's. You could have bought Macy's 5 years ago for about $50, $60. And then your money is like $8 today. Same thing with Overstock. Overstock is an e-commerce company. E-commerce is like a great trend that you can invest in. Both of them are retail e-commerce companies. Overstock has barely moved from where it was 5 years ago. There was a time when it even hit like $70. And right now it's back to $20. So this is a stock that if you thought, oh, Overstock is going to do well and you bought it, and all of a sudden, 5 years later, you're like, you've lost money. Those are not great stocks to pick. However, if you bought like an e-commerce ETF, like SPDR, so the ETF captures a basket of stocks that are in e-commerce. Macy's may be in it. Overstock may be in it. But because it also has other companies that have done really well, like Amazon, like eBay, or other e-commerce companies that have done well, you're generally tracking a trend that has a long-term growth profile than exposing yourself to risk of individual securities. So, Maya, move on to the next slide, please. So I also want to talk about, research tools that I use. Yahoo Finance is one that I really like because it's very accessible. I don't need to log in or anything. I go in there, look up a stock, look up key metrics about the stock. If you also want to screen for ETFs, you're trying to find specific ETFs, ETF screener is etfdb.com is a good one. And your online brokerage also has research tools if you want to get more information about particular stocks or ETFs. Any questions? Because I think that's come up to the end of our presentation. And sorry, guys, I didn't realize we have so many questions. I would have tried to move through this a lot faster.
So you advise against this Nicola, right?
Yeah, I mean, if in 1 month time, if the stock is $100, you may start cursing me out, but the stock could also be zero. Yeah, so I typically it's really about but my advice is this: you should be willing to take some crazy risk like this because we're all young, right? And if you want to place a bet on Nicola, make sure you understand the risk of your bet. So right now they don't have a product, and there's no guarantee that they'll bring the product to market. But at the same time, they could potentially be a great stock to invest in if they do really well, right? So my advice is put a small part of your portfolio in Nicola.
A small part, as in how much are you talking about here?
Maybe if I don't know how much your net worth is, but if you're someone who has say like $100,000 to invest, maybe you can put $1,000 in Nicola. So if you lose that $1,000, it won't impact your portfolio too much.
Okay.
Yeah.
Whatever you can take and say with, that's it.
If you're what?
I said whatever you're comfortable to drink NSA with, you can invest it in.
If you're comfortable with, sorry, I missed your question.
No, whatever you are comfortable to drink NSC with.
Exactly. Great point. Whatever money you think you can blow at any time, you know.
This is the Giracolo guy.
Yeah.
So, any other questions for Azan? As Deji, you have a question?
Yeah, I have one question. I mean, talking about this ETF, yeah. I mean, this is my first time of actually hearing about it because I'm active in the stock market, but I've been doing like individuals. You know, I make, I lose. You know, been mixture of everything. But speaking about this ETF, is it like something? Because I've been in and out. You know, the presentation. I have to apologize for that. Yeah. Like for the ETF, is this something I can trade normally? Just using my what's it called right there? Using my brokerage firm.
And that's one of the benefits of an ETF. You can trade ETFs like regular stocks. And it's one of the key differences between ETFs and mutual funds. ETFs you can trade during trading hours, in extended market hours, and they have the same liquidity profile as stocks do. But
okay, sorry. So if I go on my Fidelity, I could just type the ticker is just ETF, and you just
no. So you have to pick particular ETF. You have to find the ticker of the particular ETF. The one example that we showed is the S&P 500 ETF. It's called SPD. It's called SPY. So SPY, you can type in the ticker. It gives you the current trading price, the bid ask. You can place your bid and buy the ETF or sell the same way you want to sell stock.
So I don't mind sharing my, this is based on the Azan's education over time. So when Azan asked me to buy this, S&P 500, was actually 277, and the last time on Friday was 319.
Yeah, so that's a good example of, making sure that you're making the gains, the market gains. So the advantage of an ETF like this is you won't do better than the market, but you won't perform worse than the market. The problem with picking individual stock is you expose yourself to so much idiosyncratic, what we call idiosyncratic risk. So risk, like you just mentioned, I don't know who the last comment was from, but you just talked about you buy some, they make money, you buy some, they lose money. The truth is, in the long run, you will not do better than the market that way. The market you're always going to underperform the market most of the time, unless you're lucky, you will underperform the market if you're going in and out or actively trading stocks. So it's always better buy an ETF. Don't give yourself the headache. Because
okay, so pretty much ETF is like a conglomeratic
exactly
portfolio. Gotcha.
Exactly. And the other benefit is if there are particular themes that you really like I mentioned, cloud computing is one, because cloud computing is still in the early stages of its growth. If you believe in cloud computing, there are cloud computing specific ETFs. The ETF screener will allow you to find them. And there's potentially they will continue to do really well. If you believe in another one is e-commerce. There are e-commerce ETFs that tracks a basket of e-commerce companies, so Amazon, Overstock. If you believe in tech, you can buy an ETF that tracks Google, Facebook, Apple, Microsoft, Cisco, that potentially will do well in the long term.
Okay, Mr. Hassan, what do you know about this Alibaba stock?
It's a Chinese stock. So Alibaba it's the Amazon of China, basically. They have access to 1.4 billion customers in China. But there's a risk with investing in Chinese companies that we've not talked about enough. The problem is with Chinese companies, the companies don't have, the companies that are, Alibaba is a Chinese company that actually listed on the US stock exchange. So the reason why you can buy them is because they listed their shares. I don't remember either on the NASDAQ or the New York Stock Exchange. But the problem is they do not have the same level of regulatory oversight from the SEC as American companies do. So American companies are required to file their financial reports, their audited financial reports every year and every quarter. Alibaba does the same, but the problem is the audit that's performed on their financials is not as comprehensive as that of a US company. It's why we had an example of Luckin Coffee, because their company was being audited, but they were being audited by Chinese audit firms that probably, I don't know, they may have been involved in their shenanigans as well. So I'm not saying Alibaba is not a great company, but you have to understand that there's risk with investing in companies outside the US market because their numbers may not be the actual numbers.
Okay. Thank you.
Hey, I got a question. Can you hear me?
Yeah, go ahead.
Do you know any ETFs that have assets like gold in it?
Yeah, absolutely. So that's if you want to invest in gold, and for someone who's interested in gold, the reason is probably because you care more about capital preservation. You don't want your money to go down. There are ETFs that actually are designed to track gold. China, I'm literally going to find an example for you here. I don't know all one offhand.
But gold prices goes up and down now.
Yeah, it goes up and down, but it's significantly less volatile than the stock market.
Okay.
So an example of a gold ETF is BAR.
BAR.
Yeah.
Bar.
Well, it's less of an ETF. It's actually a gold trust. So there may be some trading limitations. Well, actually, it's not a trust. It's actually an ETF. So if you search for it, it's actually done well in the last 1 year. And the reason why it's done well is because there's still a lot of concern about, how healthy the economy is. So in the last 1 year, it's actually gone up. So if you're someone who wants to buy gold, you can buy this ETF, and it may not fully track the performance of gold, the commodity, but it'll give you exposure to companies that are in the gold mining or gold selling industry.
Okay.
So Hassan, what is the situation with oil now?
So oil, the background, I think the reason why I asked that question is there was a time last month, I think it was May or end of April, when oil prices crashed. And you actually had oil contracts for middle of May trading negative. I think the oil market has sort of stabilized. There is the reason why the prices crashed back then was one, Russia and
I think it's Saudi Arabia and
Russia and exactly. So Russia and Saudi Arabia were at odds. They were fighting over who was.
They were actually increasing their output. So
yeah. So Saudi Arabia and Russia were increasing output to gain market share. So there was a lot of conflict about what they would do. And also you had the demand shock that happened from all the lockdown. So all of that impacted the price of crude oil. So
it's going up now.
Exactly, the price crashed. So I think now that economies are opening back up, and then you had Saudi and Russia agreeing to cut prices, even the US agreed to cut production. The oil prices have stabilized, and I think they're in like the low 30s now. I don't know where they're going to go.
36 right now. I think 36 right now.
Yeah, exactly. So I don't know where they're going to go. I generally stay away from investing in crude oil because I don't know a lot about the dynamics of the industry. And I just think I can get better returns in other places.
And cryptocurrency? Anything about it? Do you know anything about it?
So yes, crypto is another interesting one. If anybody tells you they know what's going to happen to the crypto market, they are lying to you. Crypto is one of those esoteric investments that you can make for speculative reasons. But if you claim to know what Bitcoin is going to be trading at 5 or 10 years from now, I will call you. I wouldn't be shy about calling you a liar.
Might be Nostradamus now.
Exactly, exactly. I don't think enough of what people know enough about crypto. Plus, there's a lot of I've read that there's a lot of the trading that happens in the crypto market is actually fictitious. Like some people just manually, not manually, but what they do is they place fake bids in the crypto market to run up the prices, and then they quickly sell. So if you're not careful, you may be caught up in, that buy sell dynamic and end up losing money if you're thinking about it in the short term. I mean, if you had invested money in Bitcoin 8 years ago, you probably have a lot of money now.
Yeah.
So it's up to you what
I
level of risk.
Around 4 years ago, it was between $16,000 to $18,000 per Bitcoin.
Exactly. Now it's less than 10,000. So
now it's around 7.5.
Yeah.
7,500.
Exactly. So it's all about your risk appetite. If you're someone who is a high risk taker and you want to invest in things you don't really understand, that's fine. But just be aware of the potential to lose your capital.
Well, Azan, we know you are on duty now. So we really appreciate your time this afternoon. It's been wealth of information. And I think when you and I first had conversation about investing and we started talking, I left that first conversation very confused. I think majority of my classmates on this call are probably more vast than I was when you and I first had that conversation. So I hope this conversation is a little more beneficial to them than I did when I had that conversation. So if you don't mind, once we are able to digest the information you gave to us and have further questions, we would like to bring you back for further clarification and more information. And I just, on behalf of the group, and I think my chairman is still on here. Femi Ogunda is the chairman of our set, in Christ School, Ado Ekiti. So if Femi is still on, maybe Femi can, give vote of thanks on our behalf. If not, I'll be excited to close this out. Femi, are you on?
Femi is not.
All right, Femi is not. Let me commission Leke to give us to thank Ezan on our behalf. I think this has been helpful.
Yes, I really wanna commend your job, bro. Thanks for coming on behalf of our set, Christ School, like you mentioned. We really want to thank you for even for your time. I mean, it's been over an hour. If we have to pay you, even if you're charging us $70 an hour, we collectively owe you $70. So thank you very much. We really appreciate it. And like Bayo rightly said, we'll digest the recording. We'll go over the slide. And if we have one or two questions, hopefully we'll be able to reach out back to you. And I just want to wish you and your family to be safe out there and be well. Thank you.
Yeah. So thank you guys very much.
Stay away from Corona.
Thank you guys very much. I agree. It was a great 2 hours. I learned a lot from everybody as well, and I'm happy to come back. I know there's going to be a lot of follow-up questions because what I sensed from the 2 hours we spent here together is practically everybody here seems to be interested and very knowledgeable about the stock market. So I've also learned from you guys as we've gone through this past 2 hours. So looking forward to coming back. Thank you very much.
Thank you.
Thanks,
Thank you so much.
Take it easy.
Yeah.
Bye-bye.
Take care, guys.
Thank you.
Bye.
Take
All
care.
right.
Bye-bye.
So guys, if you are still on here, I want to see your face. I think maybe it's not needed. I was gonna take a screenshot to send to Fadikwe, to send to BK Tisha for us that all of us we are wishing her a very healthy birthday and long life. I did take a screenshot at the beginning of the call and I sent it to Sheung.
Don't send Goke's bald head, please. Don't send. I mean, like
Wow, okay.
Bayo, just share a video here at the presentation, please.
Yes, absolutely.
Thank you so much.
All right, guys, I'm about to take a screenshot. So if you are there, it's coming. 1, 2. Screenshot is not go. All right. Thank you, guys. So I'm gonna send this to Sheung. Wish mommy long life and prosperity. All right, fellas. Thank you so much for your time. Looking forward to next month. If you have suggestions on
how are you?
If you have suggestions on what we should talk about next month, please let me know.
How are you?
Maybe real estate, bro.
Yeah. Anybody who can
real estate farming, please.
Yeah, okay, real estate farming, okay.
Yeah.
I agree too.
I
am babysitting. This boy would disturb the meeting. That's why I deliberately left myself out.
Yeah, we understand, man. We understand. Yeah. Good to see you, bro.
Yeah.
Hello, Bayo.
Yeah, go. I can hear you.
I think
sorry, I'm in a store. I'm muted, but that was a good presentation. I know, I used to be commodity broker in the past, and everything it talks about is up to the point. So but one of the things I also would like to, if possible, whoever's interested, with the forex. That's one of the areas that we never got into. Forex is not traded on exchange because it's a liquid market. So whoever's interested in forex, it's something I can share. Forex is very, very volatile.